Hello and welcome everybody to another episode of the Reside Daily Bite. I'm your host, David Doucette. Today I want to talk to you about interest rates and the reality that they will be going up. How soon, how quickly, we don't know, and to how much remains to be seen, but they will definitely, we think, be going up. And I want to share an article that came out in the San Francisco Gate about a month or so ago. Talks about the Federal Reserve, and they've been pumping a lot of money into the real estate sector. 1.25 trillion with a T dollars they have been pumping into the sector. That program ended last month. Mark Zandi, chief economist with Moody's, says housing has been on government life support, and without it the crash would have been much more severe. He also states that this spring and summer, as those policy efforts unwind, we most likely will see mortgage rates move higher and more home price declines. And the experts are agreeing that the Fed's exit will cause mortgage rates to rise. The big unknown is how severe the effect will be. Guy Cecala, publisher of Inside Mortgage Finance, states there is no question rates have been kept artificially low by the Fed's heavy buying. My opinion is that rates will go up a full percentage point initially, meaning that a 30-year fixed conforming loans now hovering around 5% would hit 6%. And that's what we're hearing as well. By the end of the year, mortgage rates are expected to be, or could be, I should say, at 6%. We really don't know. A lot remains to be seen. With that said, I want to give you an example of the difference between a 5% mortgage and a 6% mortgage. So let's take let me zoom in here in my fancy, come on cameraman, there we go. We're zooming in. So at 5%, a $500,000 mortgage, and this does not include property taxes. Let me get down here. This does not include property taxes or insurance, just the straight mortgage. Your payment will be about $2,700. At 6%, that same $500,000 mortgage, your payment's going to be about $3,000. Difference of about $300 times 12, $3,600 per year difference thereabouts. Now, $3,600 is a lot, and this is for the same mortgage, the same house. It's just a difference between 1 percentage point. Let me just show you over the life of a 30-year mortgage what that looks like. Let's see, you'll spend roughly in interest on a 5% $500,000 loan over that 30-year span, you will spend $466,000 just in interest. On a 6% loan, it's going to be more $579,000. So a difference of about almost $15,000 over the life of that loan. Now, with that said, most people stay in their home or move every 5 to 7 years, but when you look at the numbers like this, it really displays or shows how, let me back this up here, really displays and shows the difference between what 1% interest rate can make. So this is really important for the fence sitters, and if you are on the fence, especially on the west side of Los Angeles, where we know the west side is picking up. A couple of episodes ago I talked about areas like Palms and Mar Vista are up about 10-11% from where they were last year. So if you're in that situation, you really need to, and sitting on the fence, get off your tuchus and really take advantage of these interest rates that they're hovering around 5%, because in another 8-9 months, we may be closer to here, and as we just talked about, you can see how that really costs you money. You can also listen to the, I can't remember the episode, it's with Dean Pillar, my mortgage broker, called The Cost of Waiting, the podcast, and there's several other factors in there that makes it more expensive the longer you wait. So if you have any questions or comments, 1-800-476-5579. Or email, what is my email? feedback@residerealestate.com. My name is David Doucette. Thank you so much for checking out the Reside Daily Bite.